Welcome to the Buffered ETF Guys, the podcast for investors who want to get retired, stay retired, and stop stressing over the next market crash. Bear markets happen, but so do bull markets. So why not be prepared for both? Buffered funds offer some downside protection and some upside growth potential so you can protect, grow, and stay rich. They're like ETFs with airbags. We could focus on timing the market, but we'd rather teach you how to spend time in the market. Get financially buff and retire well with the Buffered ETF Guys podcast. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned in this podcast, including specific investments mentioned, should be taken as a recommendation. Welcome to the Buffer Guys podcast. We're going to have some fun. My name is Mike Massey, and this is...
I'm Dallan Maas.
And we're going to talk about buffer investing. Now, buffer investing takes on a lot of personalities. You may hear of buffer ETFs or defined outcome or accelerated or floors or tactical strategies. Anything that really just tries to not sit in the market and have full unlimited upside exposure and full unlimited downside exposure. That's kind of what I think about when I talk about buffers. What do you think about?
Over the past, I don't know how many years have they been out, 8 years or so, where they've become very, very popular. I really think of them kind of like you said, they've come out with a lot of different flavors now to where if there's different risks that you're concerned about, they've got a product that can maybe match that up, more so than just, hey, am I in the market or out of the market? There's things that you can have to say, I'm in the market kind of, but I'm also, managing my risk on the downside. But I think that's kind of how they've been used as tools.
One of the things you'll see on the podcast is we'll probably say something right after each other, the same type of deal. We may say it a little bit different way. We may pick up on something that the other person didn't say, or maybe we kind of say the exact same thing, but in a different kind of personality or brain framework, if you will. So you'll see that a lot on this, and I think it'll be helpful for us. So we'll learn that way too. Just give it what your definition of a buffer might be, like a simple definition or an example.
So most people are familiar with the S&P 500, right? That's one of the broadest, most popular stock indexes in the world. And there's a lot of these buffers. If you want to say, well, what is a buffer? If there's an S&P 500 buffer, you say, I'd like to buy a buffer instead of buying the S&P 500. And what's that experience going to be? How's that going to be different? I know when I buy the buffer, there's a defined outcome. So let's say it's for 1 year. I know that for that 1 year period, I have a cap. Here's the most that I could make out of it based on how the S&P 500 does. And here is what kind of loss protection that I would have during that time period. So it's really comes down to, hey, S&P 500, I want to participate. Here's how much I could participate. I want some protection. Here's your protection. And there's a lot of different ways to go about it.
Yep. And over the podcast, we'll be talking about the different ways, not all of them, but we'll go in depth on some. Can't make any recommendations. So anything you hear on here, we are not recommending for or against it. We're going to simply do our best to talk about different concepts. We will even at times talk about specific buffers or maybe even specific ETFs, but we are never making recommendations. So you should always consult your own advisor and do your own homework. We don't make any recommendations. So quite simply, what I might define a buffer is instead of being fully in the market, where you have all the upside and all the downside, you have some participation in the market on the upside and limited participation on the downside. And they take on a lot of different forms. One form might look like this, where you have, like Dallan said, a cap. Maybe at that point in time, and I'm making this up, right? Because every cap is different per product, per company, different expense and fee ratios, fee structures. Well, typically the fee structures are similar in an ETF. It's just the amount of the fee. But you'll also have different times of the year. A company that issues one today and another company that issues a darn near identical one tomorrow, will probably have at least a slightly different cap, slightly different fee ratio. But let's just say one came out on the S&P 500 and it says, okay, gross of fees before any fees, you get over the next 12 months. If you stayed in it for that 12-month period, typically defined as 365 days, they'll tell you the exact ending day and the starting day of inception. And let's say they give you up to, I'm making this up, 6.5% gross cap. So that means if the S&P 500, if that's the reference asset, over at the end of that period, if the S&P was up 6.5, based on that, then you'd get the 6.5 less any fees. If the S&P went up 20%, you would have got capped at, say, that 6.5%. And you say, well, what am I getting if I'm giving up, if I'm capping myself on the upside? Well, the buffer is going to buffer you on the downside so that you don't have that unlimited downside exposure. They work in different ways. Some of them will say, like, for example, maybe that one says you have zero downside risk to the market. So over that 12-month period, if it were going to mature a year from that day, if the S&P were down 10%, you don't lose anything. You get your money back. If it was down 50%, you don't lose anything. You get your money back. So that's an example of how I might explain, just in a broad context, what buffers might look like. What would you add or take away? Or
I think, the important thing to remember, two things. One is it is an ETF, so it's traded every day. There is a price fluctuation, every day that you can look at. The important part that Mike said was, there's a beginning point and an ending point. So if it's a 12-month, 1 year, when you say, what is this buffer going to do? It's from point, today to 12 months from now. In between there, based on the market fluctuations, it's not going to follow the market every day. By the end of that 12 months, it'll do what it says it was going to do, because the options are that it uses options. We haven't really talked about that part yet, but it uses options that expire on that last day, and whatever the value is supposed to be, it will be.
So you're telling me that if it's in the ETF form, which is typically what we're talking about, not a mutual form or annuity form, but an ETF form, it's actually liquid and marketable, where you can get out pretty much any day?
Yes. Yeah.
And does that guarantee still hold true if you get out during the middle of the period?
No.
Why not? Or what happens?
Because, not to get too much in the weeds, but if you buy an option today, the value of that option is made up of two things. One is the intrinsic value based on where the stock market is if the stock market goes up, the value of that option goes up. But there's also a time value. So as you get closer and closer to the expiration, there's a value change that goes on with that option. And so in between times, the value of that option is not going to reflect exactly, if the market's up 1%, it's not going to be up exactly 1% if it's still within that cap, because there's a drag on the valuation of that option. But come to the end, that valuation catches up, and it is exactly, well, I shouldn't say exactly, but it is what it's supposed to be, at the end of that time period, whatever time period you bought.
So if I bring in some examples of this liquidity and marketability and being able to get in and out, some things that come to mind are bonds, CDs, annuities, right? If I bought a bond, a 1-year bond, and it said I'm making this number up, 4%. Well, if I sold it between now and the time that it matures, let's assume that it's marketable and I could go out and sell it and there's a buyer. It may sell for a different price than if I held it the whole time, right? And CDs, wouldn't you agree that there's many, not all of them, but some CDs allow you to get out prior to the expiration, often for some type of penalty, maybe like a month's worth of interest or a quarter worth of interest, right?
Yeah.
And annuities, a lot of annuities will allow you to get out early with either a surrender charge or a market value adjustment or whatever term they may term it. So there's actually a lot of instruments out there that have some type of a predictable ending, but you can get out in the interim, but maybe at a higher or lower price, depending on some factors. So not much different than that. But in the ETF form, makes it very marketable, where you can buy it on the open exchange, and you can do that at a lot of different brokerages, typically Schwab, Fidelity, Vanguard, you name it. A lot of them allow this.
You bring up annuities. It used to be for somebody to have this type of tool to use, you had, about the only place you go is an annuity to get this type of protection. There's all kinds of annuities that had, different buffers and, guarantees of certain, downside protection.
Mm-hmm.
And so it was wrapped in an annuity. They've just taken that now and they offered it in ETF, which goes to a broader, probably a broader market of people to be able to access this type of tool.
So it's interesting. A lot of advisors out there, or even investors, because if it's an ETF, you don't actually have to buy it through an advisor. You may be able to buy it on your own. Some, our clients may be able to buy it on their own with us. So there's a lot of access to it. It's interesting because a lot of advisors or investors who used to hate the word, hate annuities, or at least hate the word or the concept annuities, seem to really like these buffers, which are, in a lot of respects, pretty darn similar, right? You can get out, but you may get out at a different price than you thought if you hold it for a certain term, whether that's a 12-month term or a 6-month term or a quarter or a 2-year, right? They come out. I've seen them in a lot of varieties. We've seen them in some that do monthly, I think quarterly, yearly, semi-annually.
There's even a 2-year.
Biannually. I think there's maybe even a 3-year. Not sure.
I know there's a 2-year. I don't remember if there's a 3-year or not.
What's the one that came up on China recently? Is that a 2-year?
I'm not familiar with that.
All right. We talked about it. You're getting old, man. You forget things. Yeah, so lots of similarities and certainly some difference to a lot of different products. We're not going to go through them, but we're trying to get the concept in your mind so that you understand. So this is pretty popular.
They've gained in popularity a lot over the last 5-6 years, it seems like.
I've seen a lot of companies come along and get big quickly offering these.
Yes. When they first came out, they came out with one each month and you had a 12-month window, like the example that we used earlier. That was kind of the most popular one. But now the menu that you have to choose from is a very long list of different buffers, which is nice because everybody's situation is unique and you can kind of find them that fits your risk profile, that in comfort level within, how you're investing.
Some may have argued at the beginning that these were a niche product, a little niche space offered by little companies. They're never going to get big. These companies, they're not really worthwhile. Do you think that's held up? If anybody believed that?
Not today.
Do you know of any big companies who are doing this?
Big companies, as far as big ETF companies, well, they've become big. There's ones that started out and they're managing a lot of assets now, and then ones that were already. Yeah, I guess the kind of where that it's gotten the attention of some of the big players is when BlackRock.
That's what I was looking for.
Which is one of the biggest, companies out there in terms of assets under management.
I think they might be the largest ETF provider in the world.
It's between them and Vanguard. I think, I don't know. They're both very, very big.
I think Vanguard's more on the index side and BlackRock more on the ETF.
It could. Yeah,
double check our facts. We're not
making a claim.
Both huge.
I guess with iShares, which is probably the biggest, so that makes sense. They got, they didn't start there, but they got big enough where it got the attention of BlackRock to say, hey, these things are gaining traction. We need to be in this market. They're a latecomer to it, but they're so big that they attract a lot of assets.
And what are some of the reference assets that you're seeing out there that you can get some type of a buffer ETF other than just the S&P 500, which a lot of people understand that?
I think the S&P 500 is what they started with because it's high volume, very broad. But as we've went through time, they've added on a NASDAQ index, which some people have heard of QQQ, which is the NASDAQ 100, top 100 stocks, where it tracks that. And there's a small cap one, one I know of is IWM ETF that it tracks, and there's international.
Yeah.
There's treasuries.
Yeah.
That it tracks. They've even come out with some individual ones. I remember they came out with a Tesla.
Oh, there we go.
One. So it's emerging markets. If you think about the different major indexes and major categories for stocks or segments, they seem to be building buffers for just about all of them.
Even crypto. You can even get buffers that are tied to the price of Bitcoin. If you look at the top 20 ETF companies in the United States, I think that probably most, if not all, will be offering these in the next 2 to 5 years. I think they're that cool and that innovative that people want them, and they're seeing the thirst for both investors and advisors. Let's step back and look a little bit about the market we're in right now, and maybe what it could have done for someone during this market, right? We're here right now. It's early May 2025, and we've had a lot of volatility this year, primarily from the tariff situation. And we had some growth early in the year. Then we had quite a sizable pullback in a lot of asset classes, not all of them. And how could some of the buffers, or just in general, or you can pick one, not going into numbers specifically, we don't talk about performance on the show because, again, we're not making recommendations and we're not going to talk about actual performance. But how could a buffer have helped us during this kind of choppy period, this volatile period?
I'd say that, each one's different, but in general, it provides, in an environment like this where you're seeing the market fluctuate a lot, but a lot on the downside, that as you watch it and look at your portfolio, that's why they're called buffers. It's buffering you, providing a buffer versus the full brunt of the stock market going down. We talked about how it's point to point, as far as what each buffer may be, the time frame that it's working on. But even during that time, if the market's down 2%, a lot of times, not every time, but a lot of times, you're looking for, well, market's down 2%, but my buffer was down only 1%, or it's down half a percent. I mean, it's just, when the market goes down, usually is when your emotions increase to where it can help you not make emotional trade decisions, where it keeps you invested. There's I know it's a rocky time, but I've got these buffers that, I feel good about, that it helps protect me on the downside. So I stay in, I'm not making trades trying to tie the market. I think that's some of the things that as I think about when it comes to those buffers. How about you?
So some of the forms, and one of the things you said was 2%, and different buffers behave differently, right? So for example, if we had one that said, again, these are totally hypothetical made up numbers. So let's say one offered, 6 or 7% on the upside for a cap and 0% on the downside. If the markets went down, it probably, if you had bought it, let's say during that period, and it was actually drawn down, the index was negative during that time, you're probably showing a little negative in a lot of those buffers. But if you hold it to the year time period, like we were talking about with the time value of those options, they start to play back in, and then they start to take you back to the zero, which is your worst case scenario in that type of a buffer. But you may have had some type of a drawdown, which really only matters if you're trying to exit.
Yep.
Or emotionally, if you're like, oh, I'm down 0.3%, I can't believe it. Right? That type of deal. There's other buffers though, right? And we'll get into these over time. We're not going to explain the whole world in one day, but some may say you're responsible for the first 5% in losses. And then after that, the company protects you on, say, the losses from -5% to -15% or -20% or -30 or 35%. I've seen all of those iterations. And so maybe then if the market's down 2, maybe you're down 2 as well, or somewhere close to. But if it drew down 10, maybe you're only down 5 in one of those buffers. So they work a lot of different ways. And that's why there's not just like one that's I just got to be in this, and this is my whole portfolio from here on out. Everybody's different. What's your time frame? What's your risk tolerance? What are your goals, right? We're taking that all into consideration. That's why everything's done on a case-by-case basis based on your unique needs and circumstances and goals. It's also why we don't make any recommendations on this show. We're just trying to broach the topic, give you some food for thought, and so that you can go and research on your own, talk to your own advisor, talk to Dallan and I. We'd be honored to have a conversation with you about your specific situation. But yeah, lots of different buffers, but emotions, that's a huge thing of what you talked about. Like, let's get into that. Let's get into those weeds a little bit.
So I don't remember who to quote, so I apologize if I'm not giving credit where credit's due, but there's studies that have shown that the pain from losses.
Dr. Daniel Kahneman, that's a Nobel Peace Prize.
Is what is it? Twice as
The statistic I remember in my mind, I think this is close, is the emotions on the negative, on the downside, are 2.5 times more powerful than gains and wins and profits on the upside.
Yeah. So that's where the emotions really kick in. If you look and see your, today or over the last, you look at your statements like over the last month, I'm up. You're feeling good, but okay, it's not that big. You go on the rest of your day. But if you look and say, oh my gosh, I'm down 5%, that triggers a different emotional response. And I really believe, just from the experience I've had with buffers over the past years, is it helps see through that in the emotion. It takes the emotion out of it, knowing how, I know how these work. I know what it's going to do for me. And, I don't have to have that type of response anymore emotionally, as I know I've got these.
Now, some people have nerves of steel, and no problem. Market goes down 20%, don't flinch. Market goes down 40 or 50%, they're not moving. They're holding tight, right? They want to buy more. They're calling like, hey, can we buy more? That you've got that type of nervous steel kind of profile out there, but that's not everybody. Then you've got other people who, their account's down 1% and they're calling you, and they're calling their broker and they're saying, should we get out? What do we do? I can't believe it, right? There's different profiles, different types of buffers that you can consider, that you can look at, that we might use or not use, that other advisors may use or not use. But the emotions play a huge part in investing, period. And buffers have come along and had huge traction. One of the reasons is because of emotions. People really like the idea that, hey, I can participate in the upside to some degree based on what that ETF, buffer ETF or defined outcome ETF may look like. But I've got some kind of either limited downside or reduced downside, or I know my worst case scenario, depending on the particular product that you may be looking at. And people really like that. So the emotional aspect of investing is really helpful when it comes to buffers.
Yes. I think, you and I, we've seen enough downturns in the market, and you hear enough stories about people having regret as time goes on. Where it's like the market went down, their emotions took over, so they just moved all to cash.
Cashed out.
Right. Cashed out. And then, that type of emotion, then that sticks with you. And then you don't know when to get back in. And before you know it, you're looking back, it's like, well, I made a mistake. I should have been back in. People that have experienced that, like we said, some people, they don't care, that they're fine. They can stomach going down, knowing that they've got time to try to see if it comes back up. There's never guarantees, right? But products like this can be attractive to people. That's like, hey, this, I didn't want to go to cash, but my emotions put me into cash, but maybe some of these buffers are a good fit for me, to where it keeps me invested, because I want to stay invested, but I don't want the emotional roller coaster. And this may help.
It's cashing out, right? Cashing out can be profitable or it can be unprofitable. It depends on the circumstances, but everybody can think through the time in the markets, or maybe you have a family member or a friend, and at some point in the past, they just went to cash. They couldn't stand anymore. They went out. They're like, hey, I'm down 3%. I'm down 30%, whatever that number might have been, and they're out. And that could be very profitable if the market then proceeded to go down a lot more, and they get back in. The hard part is getting back in, right? You got to get out and you got to get back in. Otherwise, you may have just locked in your losses and then you don't get back in. So it can be unprofitable for some people to cash out. And that's why most financial advisors, most market commentators, most people in the money management space say, don't cash out, and be very careful and understand, if you cash out, you got to know what your entry point's going to be. How are you going to get back in? When are you going to get back in? Because usually when you feel like throwing up the most, may indicate a good time to get back in, or a time to get back in. But when the markets are nasty, it's hard for people to want to jump back in. I had a client say to me the other day, he said, Mike, someone asked him, he said, I had a neighbor, hey, did you get out of the market? He said, no, I'm not going to jump off of a moving roller coaster. He says, I don't want to do that. That's not smart. I understand that the market's a roller coaster and I'm going to stay on it. I'm going to trust it's going to get me back to where I need to be. And that's not necessarily the case, but over time, the markets have typically, most markets, the major markets, have recovered over some period of time. Though some people don't like that downside and they don't like to wait for the recovery period, right? Maybe that recovery period is a week or a month or a year or 5 years or 10 years. Maybe it's a lost decade in whatever asset class it could possibly be, in equities or some kind of commodity or something. But understanding that, and that's where the emotion can be where the buffers can really come in and be beneficial.
To kind of take the emotion out of the decision.
Yes, or reduce it.
Reduce it.
Yeah. Even if you have a zero downside type of buffer, you still may have some emotion, right? Because people can still be like, I don't care. I know I'm going to end at zero because of someone's in the White House or this person this or my favorite baseball team lost, whatever the excuse may be. People can get fidgety. We're emotional beings, right? God made us with emotions, and those emotions can be good and bad. But one thing I tell people is we got to be careful trusting our feelings, because feelings can lie to us. So we want to be careful. But buffers can certainly help with the emotion side. What about taxes? What do you think about taxes in regards to some of these buffer ETFs? Not all of them, but in general, what do you think?
So in general, so the nice thing about it being in an ETF is from the day you buy it, there is nothing from a tax standpoint that you are having to manage until you sell. So you can hang on to these ETFs for long periods of time if you want, right?
If it matures in a year, can you hold it longer?
Yep, it just reset. So if it's like a 1 year window buffer, it just means it resets every year. So you just hang on to that ETF, it resets to a new cap, and a new buffer, whatever that might be, and you go on from there.
So just like if someone bought, say, the XYZ ETF and said, I'm a buy and hold investor, I'm gonna stay in it for 20 years or until I die, you can do the same thing here?
Yes, absolutely.
And even when it quote unquote rolls or resets or however you want to term it, and a year from now it's got different caps, that's typically not a taxable event?
No, it's not.
That's pretty awesome.
It is.
But if I sold it earlier than a year, then I'd be treated with probably short-term gains or losses, depending.
Yeah, just like if you owned a stock or any other ETF, it's viewed the same way from a tax standpoint.
And that's quite different than the traditional, what people might call like structured note or structured CDs, where those, when they come due a lot of time, there's a taxable event, even if you want to continue a similar structure moving forward, right?
That's right.
This has a huge advantage there. I like that. Again, not a recommendation, but that's something that you should be thinking about. So we've talked about a couple of major factors. One is emotions that buffers may be able to help with. And two is taxes. Look into the taxes some more. Continue to listen to the podcast and learn more about this. Talk to your advisor, talk to the company, read their literature. You can see what the tax ratio is in different places, maybe on their literature or maybe on Morningstar for those who have a 3+ year track record. But from a lot of them that I've seen, if you hold it for more than 12 months, generally, I mean, it's an ETF. Right. And they've had some favorable tax rulings, private letter rulings, and whatever it is. I don't want to get in the weeds of the jargon, and I'm certainly not a CPA. We don't offer tax advice on this podcast, but they did have some favorable things that a lot of companies are essentially kind of getting into that fold, just following along, and they're getting this favorable tax treatment on a lot of these, even though there's stuff going on inside of it, right? I mean, they're buying these options, and they've got expiration, and they've got new calls and puts and different things going on. And even with all that movement, tax efficient, right? That's very beneficial, because if someone just wanted to try to go out and buy puts and calls and do these, create an option strategy themselves to go out and do it, they'd be having all these taxable events.
Absolutely.
But you can package it in an ETF and get tax efficiency.
Yes.
Awesome. Of course, if you do it on your own, maybe you don't have to pay the fees of the ETF company.
It's true. But
you also may have a higher price of your options. I'm not saying you do, but maybe that's one potential cost, is if you're buying small lots and small options, maybe your pricing power is not as big as these big ETFs that are going after it.
Yeah.
Right? So there's pros and cons in everything. Everything in life, everything we do. I'm constantly teaching my children this, constantly talking to my colleagues and partners and everybody in my life. No matter what we do, there's a pro and a con. The idea is to think through it. What are the pros? What are the cons of this? What are the pros? What are the cons of this? Let's weigh them. Let's compare them. And then each person may make a different decision based on that, but make an informed decision. So this podcast really is about making informed decisions. We want to help inform you of things, pros and cons, so you can go out and make your own informed decision on your own or with your financial advisor, or you can contact us and we can have a great conversation.
I think that's a great point, because there's no silver bullet, one investment that fits everybody. That
You didn't bring your silver bullet?
bring a silver bullet.
You sure?
I'm positive.
You got a gold bullet?
Nope. But each one of the has a place, and a fit for different investors. And it might be a big part of a portfolio, it might be a small part of a portfolio. I mean, it's good to understand what they bring to the table, what benefits they have, but also know that there may be things you're giving up by getting into them.
Mm-hmm.
So I think they're proven to be, as far as in the past, a good tool, to use for the benefits that we talked about already, especially from an emotion standpoint, staying invested. But it's not a silver bullet. There's things, if you get into them, you are giving up, and maybe you're giving up some upside on years where the market goes way up. You're going to look at it and say, I committed to this and said, I'm okay that it's at a cap, that I'm only going to get so much. But there's going to be years you may be giving up some, but there's going to be other years he's like, well, it really helped my overall returns because compared to the market, because I didn't have any of the downside.
Mm-hmm.
So
what about tariffs? I don't think we talked about tariffs. Did we mention them?
Has anybody talked about tariffs?
What is it? Does anybody know? Maybe part of the problem. So let's talk, maybe even in the show or close to the end of this podcast episode, let's just talk about some of your thoughts around tariffs.
We might need a whole nother show, Mike.
You're not going to like me. No, he's going to hit me after this podcast.
So ask me again. Dude, what's my thoughts on tariff?
I just say the word tariff and then you take it from there.
Okay.
It'd be like a board game.
What we've experienced here over the the past few months when it comes to tariffs is that I'll try to make this so I don't want anybody responding saying, why'd you have a political show? This is not a political, believe me, it's not a political answer. If you're going to put on tariffs, I think it's what's causing what we're experiencing is not just, okay, what are tariffs? What does it mean for global markets, for companies, consumers? But, I think we haven't landed yet on what the long-term tariffs are going to look like. I think it started out saying, here's a tariff that, okay, now we're pulling the tariff off, and it's going on. I think that as much as the tariffs themselves has probably caused a lot of the anxiety as people watch and hear the news. It's just, in the market, it's kind of probably the same way. I mean, a lot of times you'll hear people say the market does not like uncertainty. And so, I think a lot around the tariff. I don't think tariffs were a surprise. I mean, President Trump had implemented tariffs his first 4 years. In his campaign, he talked about tariffs. So I don't think the market was surprised that he's implementing tariffs. I think the part that is causing a lot of the uneasiness is we don't know where they're going to land. It seems like, like I said, tariffs are on one day, off the next. Okay, now here's our tariffs. Well, now we're going to carve out some exceptions. And so I think when the market gets to the point where they feel like they have a good understanding of what they're going to be going forward, then they can plan and adjust. That's a long answer. What do you think?
Yeah, the key word that stood out there is uncertainty. And you have everybody who's got any kind of a megaphone, who's got a blog, a podcast, a TV show, their guest, their commentator, money manager, hedge fund manager, wealthy, etc. They've all got opinions. I don't think there's many models that actually have tariffs built into them. So I think that's one of the problems is they don't really know how to model this. There's not a big experience going back through history. But the word uncertainty is so interesting, as if the market like runs uncertainty, and we're usually in these certain times. The market is filled with uncertainty at all points in times. I think it's really just kind of expectations. Can they model it? You've got negotiation. Negotiation demands uncertainty, right? If you have certainty, what are you going to negotiate about? The things going for President Trump on the negotiation is he's got that uncertainty and perhaps a strong hand with the American economy and the power of the just America, everything.
The consumer.
American consumer. Yep. And then you've got other people who may not like the size of the tariff or how he calculated the tariff or that it's going to disrupt international trades or businesses can't plan, or they're just from a political aspect, they're opposed to everything Trump says, even if he said there were no tariffs or there was 0.001% tariffs. But the word got thrown out there. That's uncertainty. It's a level of uncertainty that they can't really quite model. So we're going to see some volatility in this, but I think that he's a smart man, and I think he's a smart negotiator, and they're going to, we'll arrive. I just hope it happens. I hope we get the tariffs up behind us sooner than later. I think the further it goes along, the more likely we are to enter into a recession. The more quickly we can get it resolved, the less likely we are to get it into not without a recession. So there's a lot of, you can look at the odds makers out there in recession. I'm not going to be calling that. I've got my own private thoughts in my head. But in the context of tariffs and uncertainty and markets, that's where the buffer conversation can really enter in. Where you can talk to your advisor and say, how can a buffer ETF or something in that realm help me during this uncertain time, during this tariff time? Or once we get through the tariffs, right, there's going to be some kind of an uncertain event after that during that XYZ time, right? What is it? Is it interest rates? Is it employment? Is it at the exchange rate? What is it, right? Is it weather? Is it climate change? There's always some uncertainty. And you figuring out how a buffer, learning about the buffers, the ones that may or may not make sense at all, the ones that may be attractive to you, and then how you implement them, at what percentages, and what combination and mixture. And that's where you get to go and do your homework with your advisor. Call us if you'd like to talk to us about potentially becoming a client of ATX Financial Planning. Any last parting thoughts on this podcast episode?
Yeah, I'd say the other thing is it's kind of talked about uncertainty. You know, there may be some people that kind of view these, say, okay, when things start looking a little more uncertain, that's when I'll move. When I want a buffer. But there's no big announcement that says uncertainty is coming. I mean, you think about, what was it called? Liberation Day.
Right.
What was announced was much different than what people were expecting, and the market moved very quickly. So by the time you decided, there's uncertainty, the market had moved a lot. You look at some other times when COVID hit, nobody was predicting a worldwide pandemic, and then it hits.
Yeah.
I mean, I shouldn't say most times. It seems like many times when there is uncertainty that hits, that causes volatility and downturns in the market, things that people had not thought of. So, I would say, these are tools to say, I want them to help me so I have them whenever uncertainty hits. I don't have to try to time the market. It's there. And since it has a tax efficiency, I can have a long-term outlook on these buffers and hold them through time, through different environments, and know I've got, buffers there to help through those uncertainties.
And one clarification on the tax efficiency, which is I've looked at a lot of these, and so has Dallan. And that's why you can call us the Buffer Guys, right? This is the Buffer Guys podcast. But we can't say for certain that every single one is tax efficient. But we have seen a lot, and most, if not all of them that we have taken an in-depth look at seem to be very tax efficient, especially relative to what one might expect if they were just running this strategy out on their own outside of one of these ETFs where they were just going out and buying the index and calls and puts and different things. What about stocks and bonds? Someone says, okay, I've got stocks and bonds. It kind of spurred my memory or imagination. I don't know, when you said something about like all of a sudden you can put the buffer on if you didn't have it before. Well, what about someone could have been in that situation and say, okay, I want all bonds now, right? I'm tired of the market, the equities are going down. I just want bonds. I want to throw a bunch of bonds in there. Is the stock and bond portfolio dead? Is that stupid to do anymore without making a recommendation? What are some thoughts or research that you might see?
We talk a lot with people, with the companies that provide these buffers, and I don't think we've never heard them say this is now going to replace the bond part of your, there is a new tool to put into your portfolio. So bonds are, people probably talk more about the stock market than bond market, but the actual bond market is way bigger than the stock market. So, the bonds are going to be there. They have a place. It just depends on what your long-term outlook is. I mean, your runway, what your individual circumstances are to say, are bonds something that should have in your portfolio, just like you make a decision, are buffers something that you should have in your portfolio, or stocks, or growth stocks, value stocks, index funds, what have you. But the thing that I like, having other things to put in the portfolio that behave differently, provide something that, like a buffer does that others don't. If you just had stocks and bonds, the reason you have it there because the theory is, when stocks are up, bonds are down, but when stocks go down, bonds go up. Well, we just went through an environment in 2022 with the inflation where stocks were down and bonds were down. So there are times where they move together. So having something there that does not just move exactly with the market is good.
Yeah. Something, just because something may have low correlation for a period of time or an extended period of time doesn't mean it's always going to have that low or negative correlation, right? So just because stocks and bonds, and I'm making up the statistic, let's say they typically, often, or sometimes go in the opposite direction. Sometimes they move in a similar direction. Both go down at the same time. Both go up at the same time. Maybe a buffer, a certain type of buffer could help that. Again, if it's maybe one of the ones that has the zero downside risk over a 6-month or 12-month or 2-year period, that's something different. And the taxes, right? With bonds, a lot of that, right? You're just thinking typical, forget the ETF bond fund. You just buy a bond, and let's say it's making, again, 4%, making this up. I don't care if we say 2% or 10%, but let's just say 4%. You hold it for, let's say 13 months. You buy a 13-month bond, and you put in $100 and you got your $100 back. Well, probably that 4% that was the hypothetical 4% would get taxed as long-term or short-term gain.
It would be short-term gain, or which is equal to your ordinary income.
Ordinary income tax, which if you're in a top income tax bracket, paying roughly 40% in taxes, or maybe someone on not the top bracket but a little lower and paying 30% or 25%, relative to many of these buffers, which I've seen if you hold over a year and sell it, you're getting that long-term tax treatment, which might be 20% or 15% in this environment, or for some people, even less, right? So that's something to think about too. So you've got the emotions, you've got the taxes, you've got a lot of different options. These are fun products to explore, whether they're right for you or not. You get to make that decision through your homework, talking with your advisor. We do not make any recommendations for or against any specific products on this show, but we are the Buffer Guys. I hope you enjoyed this podcast. We will have many more to come, so come and join us. This is Dallan the Buffer Guy. I'm Mike the Buffer Guy. Y'all have a blessed day.
All right. Take care, everybody.
We hope you enjoyed this episode of the Buffered ETF Guys. Please hit that subscribe button now so you never miss an episode. Please consider sharing this podcast with someone who could benefit from it. And if you'd like to schedule a meeting with ATX Financial Planning, please go to atxfinancialplanning.com to book a meeting. atxfinancialplanning.com. We're headquartered in Austin, Texas, but we can help people from coast to coast. Be on the lookout for our next episode, and stay wealthy by protecting your wealth. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned in this podcast, including specific investments mentioned, should be taken as a recommendation.